Pivotal indices have shot up 50% from March bottoms and just 9% short of all-time peak, backed by uh, excessive liquidity, although not the broader markets. And Mayank very well explained to you about the P and other ways of looking at this rise in the markets. Mid caps have moved up less, and small caps in general have risen the least, relatively. And this seems so confusing, but it's nothing new. During World War II, American markets bottomed out in 1942 itself, 3 years before the war was over. In fact, by 1945, markets scaled a new peak. Similar things happened after the global financial crisis of 2008. Another notable trend witnessed in the last 3 to 4 months has been a surge in new direct equity investors, particularly young professionals, opening up trading accounts and inactive investors becoming active on the stock market. Hyperactive in some cases. Two things could have caused this: working from home and the resultant spare time, and having savings due to lower consumption during the lockdown. Interestingly, it's not unique to India. This trend has been witnessed in America as well. These investors have not yet seen a major reaction in the market, and there's a fear that this could be a bubble building up, which could burst when markets do not reflect their optimism, causing immense pain to such investors. I wish it doesn't happen that way. Interestingly, mutual funds have recorded lowest inflow in recent years during June and July, signifying that existing matured investors are using this rally as an opportunity to book profits or taking some equity risk off the table. Considering the uncertainties lurking ahead, this may not be a bad strategy. Personally, in the absence of any further economic stimulus, I think markets may react a bit from current levels and witness a time correction with a longish period of range bound, maybe dullness as well. It would be like something like a storm before a lull. Investors will need to brace for volatility and navigate it carefully on the side of caution with patience. Those who can do so will reap immense benefit after the huge consolidation in industry. Big will become bigger and strong will become stronger as many others close down. It may not be an overstatement that we may witness the cliched mother of all rallies in the long term. Apart from tactically taking off some equity risk off the table, if required in the near term, the current rally could also be used for reshuffling the portfolios to improve the quality of stocks and funds. Investable surplus could be deployed gradually during market dips or through regular SIPs. Of course, one can always spot a great stock at reasonable value. Keeping some reserve ammunition in the form of investable surplus, patience, and resilience to volatility could be useful. Multi-cap equity funds will be the best bet. After the recent run-up in large caps, deploying through a passively managed index ETF could also be wiser. If the liquidity flow continues, this is where a significant portion goes. Very long-term investors who have the guts to withstand the interim volatility can look at mid and small caps as well. Not only they still have some value left in them, during a sustained bull market, they tend to be the best performance also. Equity themes that could play out includes rural, agri, pharma, all of which function as essential services even during lockdowns. Select infrastructure and related sectors, select cyclicals, select specialty chemicals, and non-lending financials are likely to do well too going forward. At this stage, most lenders may be avoided. However, after the recent sharp run-up, it may be wiser to be selective and wait till clarity emerges on the post-COVID outlook and guidance from most companies. Today, even most of the managements have no clarity about this year's performance itself. Looking at underperformance of Indian equities as an asset class over the last few years and the massive rally in stocks led by unique business leaders like FANG stock, uh, the Facebooks and Apples and Amazons and Netflix and Googles of the world, interest is also emerging investing in equities globally. It also provides a currency hedge and can be conveniently done through the fund of funds route sitting right here. This is likely to emerge as another behavioral change in financial markets. Having discussed most asset classes, let me highlight the importance of asset allocation and diversification across asset classes as an integral part of your investment process to achieve your financial goals, keeping in mind your risk profile and time horizon. I will just share one slide with you at this juncture to make you understand this. So if you can see on the screen, these are the various asset classes, which includes gold, large cap, small cap, mid cap, international equities, corporate bonds, credit risk funds, real estate, GSECs, and treasury bills, money markets. And across 9 years, from 2010 to 2019, actually 20 years, and you'll see that different asset classes in different years actually behave very, very differently. So gold could be outperformance in some years, but mid caps or international funds could be outperformance some year. In 2014, the small caps, again in 2017, the small caps were the top performers, whereas in 2015 the credit risk fund, and 2016 the GSECs were the top performers. And today's the gold is becoming the top performer along with international funds, but gold was at the bottom of this chart for an extended period of 2013, 14, and 15. And this is what I was trying to highlight to you, is the importance of diversification across asset classes. So having said that, so maintaining simplicity and discipline in your investment thoughts and process helps in winning over the emotional cycle of greed and panic. And not doing so makes you create a crisis. Ladies and gentlemen, wise investors never let a crisis go waste. Thank you very much. Over to you, Mayank.
Thank you. Thanks, Naresh, for some deep insights into how one should invest. Just very briefly, I'll maybe talk about a couple of trends or behavioral changes as we talk about that we probably will continue to see in the markets. Now, if a year ago, if somebody had said that in January of 2020 the Nifty will be at 12,400, in March it will be at 7,500, and then in June we'll be again at 11,500, everybody would have said that there's something wrong with you. What are you smoking? But that's exactly what's happened. Now the point of this whole wild swings that have happened in the market, I think it's also a great deal because of the hyper connected world that we live in today. We are connected 24/7. We get news from all over the world instantly onto our mobiles, onto our messaging services, social media, in our email boxes. And therefore, people all over the world tend to react much more than they should. And that reflects in the volatility that we see in the markets. Therefore, in March, even when there were no buyers for bonds or even gold fell, for example, there was complete panic. So I think one trend that we will probably continue to see is volatility. I don't think volatility is going out of our lives from markets, but people, as Naresh said, we should probably take advantage of this volatility. And as Warren Buffett had said, be fearful when others are greedy and be greedy when others are fearful. So if you behave in a very contrarian manner, this will be to your advantage. But of course, you will have to sort of have a lot of guts. You'll have to have a longer term time horizon to take advantage of this volatility. But volatility is a trend that I think firmly will remain in the financial markets going ahead, just considering the way that internet has taken over how we look at information and how we share it. In a couple of other trends that we are seeing, of course, and no rocket science here, but digitalization of the entire economy will obviously get a boost. Digitalization not only on the way that we shop, for example, or from the way that we do online purchases, but even on the banking side, on the way that we pay people, on how we do a lot of financial transactions, they have kind of moved all online. Digitization, if you look at the government services today, a whole host of government services actually come to us on a completely digital platform. And that includes the entire tax infrastructure, not only income tax, but also GST. That includes a lot of judiciary services. That includes, a lot of access that you do on, government websites, e-tendering. A lot of government services are completely online now, and therefore that will increase, and digitalization will increase on those services as well. We will also see obviously much more e-commerce happening, and we've seen many large conglomerates now getting into that space. And the FANG stocks that have taken US to new highs, we'll probably see similar trends that will come up in this country as well. So digitalization is another huge big trend that I see happening. Finally, I think formalization of the economy will also increase in a very big way. There will be consolidation. People will trust bigger names. People will trust, corporates who have better governance practices. And there will also be a sort of a toll that the COVID will take on people, on businesses actually, smaller businesses, which sort of don't have the wherewithal to survive such a large lockdown. So it's unfortunate, but there will be formalization of the economy. The bigger will probably become bigger, and some of the people who are leveraged, who do not have the wherewithal to survive, will also kind of go down or shut shop. So I guess these trends will also translate into how you invest in markets. Uh, Again, very general sort of advice, but please look at companies that are larger, look at companies which have much more robust business models, who have cash flows, who are growing, and most importantly, who have managements who are actually looking out for the shareholder rather than for their own gain. So this is sort of, I'll end over here. If there are any questions, please kind of feel free to post them on the chat, and we'll make an attempt to answer that. Otherwise,
Yeah, Mayank, there are questions which have been put to me because we have kept it only to the host to not let disturb it entirely.
right,
So, if you want, can I tell you?
sure,
So, and you can decide whether means Mayank or Pachisia ji will answer it. So
sure.
there is first question is that whether the going forward the online groceries and online shopping site they will rule the world post COVID.
Well, I don't think they will rule the world. The business will become into a hybrid business model. And if you see what GeoMart is trying to do, is they are tying up with your local Kirana store, and you can therefore go on, the sort of website or the app, and you can order what you want. And it's the local guy who will get that order, and then he will deliver it to you, in a few hours' time, probably. So it's probably going to be a hybrid model that will coexist. Just one or two or five e-commerce websites or grocery sites obviously cannot take care of the demand that will be there in